Welcome to our Taking Stock video for the week ending the 18th of August, 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jace.
Thanks for having me, Kien. It's always a pleasure to be on.
Yeah, I know you're very busy during reporting season, but it's great to have you on board. But before we get started, just a quick yet important reminder, the information we provide during this episode is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile and any charts or tables we present shouldn't be relied upon as a guide for future performance. Well, Jace, we are now over halfway through the reporting season and results on average appear to be meeting market expectations. But despite this, the market has become increasingly nervous. Firstly, on the deteriorating economic outlook for China, and also signs that the US could be forced to keep interest rates higher for longer. So, Jace, quite a few issues with China at the moment.
That's right, Kien. Over the past week, China's central bank unexpectedly cut its benchmark interest rates on the back of disappointing retail sales and also poor industrial production figures. And this is not to mention that the country is battling a deflation problem and a worsening property debt crisis after it was revealed that a majority or a major property developer, GUD Holdings, was potentially on the brink of default. This comes on the back of debt problems faced by Chinese developer Evergrande less than 2 years ago, which sent shockwaves around global markets.
Yeah, incredible, Jace, creating a lot of volatility in the markets right now. But this unfolding situation highlights the escalating risk of insolvencies in an environment of rising interest rates. And a key theme this reporting season has been the rising cost of debt, which has impacted the profit margins of many over-leveraged businesses. For example, Amcor, a large packaging company in marginal financial health, they missed market expectations this week due to higher than expected interest expenses. And the business has significant debt with its total liabilities to total tangible assets in distress levels, while its net debt to equity ratio is around 137%.
That's right, Kien. And it's important to remember that businesses like these, no matter how large or small, are potentially vulnerable in this environment. And not surprisingly, the stock is down 20% for the year to date.
Yes, Jace, the risk is very high at the moment, but given the busy week of results, let's now turn our attention to some star stock highlights. We had automotive parts manufacturer and also star income stock, GUD Holdings. They released their full year report, which surpassed expectations. The stock climbed about 10% on the day. What was the key driver of this?
Well, Kien, profits were roughly 3% higher than expected, but the real driver was the surge in cash flows. GUD has managed a high debt position since acquiring Auto Pacific Group in 2021, so the market was very happy to see operating cash flows more than double year on year. The upturn was a result of smoother supply chains, allowing inventory levels to reduce. And lastly, the outlook for Auto Pacific Group was pretty upbeat with new vehicle supply into the country on the rise. This should bolster demand for four-wheel drive accessories like roof racks and also tow bars.
Yeah, with retailers like this, Jace, cash flows and also keep an eye on inventory levels. It's so important. But Auto Pacific Group, or APG, represents close to around 20% of the group's total earnings. And GUD recently announced the sale of its Davey water business for around 65 million. And this should also help pay down its debt and secure its strong financial health rating. In addition, the business has become a more pure play automotive business, and earnings growth over the next 2 years should remain strong as it takes advantage of the strong demand across SUVs, four-wheel drives, and even electric vehicles. This in turn should help sustain and increase its dividends, with the company on a gross dividend yield of around 6%, and it's due to go ex-dividend on the 25th of August. Now, shifting to hearing implants manufacturer Cochlear, Jace, the company's earnings aligned with expectations, but its financial year 24 outlook was quite robust, about 4% higher than expected. What was the reason for this optimistic outlook, Jace?
Well, the favorable guidance was predominantly driven by an escalating demand for the company's hearing aids. There was also a backlog of surgeries from COVID, and that was a potential tailwind into this latest report, which indicates increased implant sales volumes potentially also into the future. Plus, the introduction of new products, including the Nucleus 8 sound processor behind the ear, will also expand the services segment and potentially lift profit margins.
I've noticed, Jace, also that earnings revisions for financial year 24 is accelerating, and that's also consistent with the upgrade. This should in turn help the company drive double-digit earnings growth and help the company to generate a return on equity in excess of 20% in the future. Now, turning our attention to share registry operator Computershare, in stark contrast to Cochlear, it seems that its financial year 24 earnings guidance was below consensus expectations. What are your thoughts on this?
Well, Kien, management's FY24 earnings per share guidance of $1.16 was approximately 6% lower than consensus estimates. Although this applies an earnings growth rate of 7.5%, it should prompt analysts to pare back their earnings growth predictions. In essence, this year's guidance appears more attuned to shifts in interest rates and also client balances.
Yes, being a share registry operator, Computershare has benefited from rising interest rates on client cash balances, but this margin income has been downgraded on the back of falling bond yields and also lower client cash balance assumptions. Of course, things can change if the RBA surprises the market by increasing its cash rate later on in the year. And lastly, a brief overview of blood plasma and vaccine manufacturer CSL Limited. The company's financial year 23 result was consistent with prior guidance, yet the outlook for financial year 24 seems slightly conservative against current predictions. Given that, Jace, what instigated the positive share price movement post-result?
Well, I think the market was excited by CSL's trajectory to achieve double-digit earnings growth in the coming years as its blood plasma supplies rebounded, coupled with growing expectations for a margin revival in the medium term. Encouragingly, gross margins rose for the first time in 3 years, resulting in a revival in plasma collection volumes and also reduced costs per litre, impacting the cost of goods sold. This influenced management's guidance for subtle gross margin boosts into FY24.
Yeah, I noticed that also, Jace, the share price appears relatively cheap, trading at a large discount to valuation. But there are several risks here that investors should be mindful about, including increased competition in the treatment of iron deficiency and chronic inflammation, as well as currency fluctuations, which was a significant factor in the company's previous trading update. With that said, though, is currency still a concern for financial year 24?
Yeah, it's a good question, Ken. Look, as a multinational corporation, I don't think CSL can fully sidestep currency implications in terms of its financial results. The substantial FX headwind in FY23 of around $245 million was due to the US dollar surge, and this is especially against Chinese yuan, the euro, and also the British pound. If current exchange rates persist, then I think management's projection of 13 to 17% earnings growth for FY24 remains pretty compelling.
Compelling indeed, Jace. It's going to be another big week for results announcement next week, isn't it? With some notable companies to announce their earnings, including Altium, you've got Hub24, BHP, Helia Group, interesting that one, IDP Education, Woodside Energy, and WiseTech. So for full details, please refer to our corporate calendar. Now for Under the Microscope, we take a look at annuities provider Challenger Limited. They presented their results earlier this week, and the company has been a beneficiary of higher interest rates really for 2 reasons. The first is that the return on their investment portfolio, which has about 58% in investment-grade fixed income assets. Secondly, rising interest rates allows Challenger to pay holders of their annuities higher yields, making their annuity products more attractive. But why did investors respond poorly to the result, Jace?
Yeah, it's a good question, Kien. Challenger posted a normalized profit growth, and this is after backing out investment gains and losses of around 10%. The company also guided for earnings to rise to between $555 million to $605 million this year. So at the midpoint of 580 is just a little bit shy of what consensus was expecting at around $595 million. And this led to some selling pressure on the day before the stock rebounded.
Very interesting, Jason. We expect some negative earnings revisions to flow through over the next few days, but I think investors will also focus on the rise in expenses, which were up about 6%. Meanwhile, high expense assumptions also led to a lower than expected profit guidance as well, Jace. With regards to the other risks, Challenger has ownership in a few fund managers, and earnings from this segment fell by about 26%. And that was due to rising expenses and fund outflows. Hence, although Challenger is benefiting from rising interest rates, it can also be exposed to weaker markets, as we've seen.
And also as well, Ken, I don't think income investors were pretty happy with the fact that Challenger reduced its target payout ratio from 45 to 50% to 30 to 50%. This means that there could be a potential downgrade to revisions in terms of the dividend forecast in FY24. But on the plus side, the additional capital that they save should allow the business to pursue other growth opportunities.
Yeah, very interesting, Jace. And if interest rates are approaching a peak in the cycle, as many economists are predicting, the investment thesis may change. And in light of the risks above, we are currently reviewing our position on the stock. For income investors, though, the stock is currently on a gross dividend yield of around 6% and is expected to go ex-dividend on the 28th of August. During the reporting season, a number of companies, including National Australia Bank and Computershare, they've announced on-market share buybacks. So a useful question this week is, what is the benefit of a share buyback compared to a dividend payment?
So very, very good question, Ken. Share buyback occurs when a company uses existing cash on its balance sheet to repurchase its own shares. And this is often at market value or even sometimes at a premium or a discount. The eventual result is a reduction in shares outstanding in the market. Now, companies might opt for a share buyback when they see no potential growth opportunities or any other better use of those funds. While there isn't a direct cost of holding on to these excess funds, the opportunity costs associated with not deploying that capital could be pretty significant.
Wow, Jace. The other thing also I noticed is that a share buyback could also provide a signal to the market that the stock price is undervalued. And it can also provide support for the share price.
That's right, Ken. In addition to this, reducing the number of shares on issue, a company can increase its earnings and dividends per share into the future. And this could aid management in achieving their profitability per share basis and even provide a cushion if there is a need to reduce dividends during economic downturns.
Yes, and in contrast, Jace, to dividend payments, a rise in the regular dividend can indicate that the company's confidence in its future business outlook and cash flows as well. However, a special dividend, like the one issued by Super Retail Group, typically offers a one-time benefit to shareholders. That's all we have time for today. And thanks, Jace, for your insights. Next week will be the busiest for us during reporting season, but we'll be available on Monday for Lincoln Live if you have any questions.
Thanks for having me on, Kien.
Pleasure, Jason. And to summarize, market volatility has re-emerged, and it looks as though our hedging strategies across our Lincoln funds have helped our clients mitigate some of those risks. But be mindful of financially unhealthy businesses this reporting season. Even large companies like Amcor are not immune to rising debt costs. And there are a few reasons for share buyback. It may signal that the management believe their share price is cheap. It could also mean limited growth opportunities, and it could also help boost profit and dividend metrics into the future. Have a happy, healthy, and prosperous week ahead, everyone.